When most people are trying to decide between a traditional or a Roth retirement account, their thinking is, well, when I'm old and I'm going to pull money out of this retirement account, I'm not going to have an income, so my tax bracket is going to be lower, so it makes sense for me to take a traditional retirement account. But you're missing half of the question. Let me show you. When it comes to retirement accounts, the goal is to do two things. Number one is to get tax-free growth of your money, and number two is to be able to retire with the most money. Now, with both a Roth and a traditional retirement account, 401k, IRA, does not matter, you're getting this tax-free growth. Now, obviously, with the traditional, you're not paying taxes when the money goes in. With a Roth, you're paying taxes before the money goes in. But when your money is in this retirement account, it's growing tax-free. The question is, when you go to pull this money out, which one is going to help you retire with the most money? And this is where I want you to go a little bit deeper and ask a few more questions. Let me clean up this whiteboard and show you what I mean. You want to ask the questions, number one, what is your future income going to look like when you're older? Number two, what are future tax rates going to look like when you're older? And number three is, what is going to give you the most growth based off of your answers here? So let me start by talking about number one, what is your future income going to look like? And this is where I want you to really dig deep and ask yourself, how much money are you going to be making when you're older? Because normally when people get towards the end of their working career, they're making the most money. And so now when you're making this money, you're probably not going to be pulling money out of your 401k or IRA, so it's no big deal. But when you go to retire, what about then? And this is going to depend on you, because for me, my goal is not to work, and then have no income coming in. My goal is to work and grow my income year after year after year after year after year, even through my older years, because I'm working to stack income from my investments, I'm working to stack income from my business, and I want to continue growing that income. Now, for some people, that's going to sound horrible. They're going to want to not follow that. They're not going to want to continue working when they're older. They want to stop. And you got to be honest with yourself. Is your goal to continue growing your income and having more income in the future? Or is your income to stop having an income in the future? And this income doesn't necessarily have to be from your work. It can also be from your investments. If you're investing in real estate, that's also an income. So like with my real estate investments, my goal is to continue growing and stacking this real estate income. And so now when I'm older, I'm hoping I'm going to have even more income from my investments versus now. It's the same question you want to be asking. Are you going to have more income in the future from your investments, from your business, from whatever you do in the future, or is it going to be less? The second question is thinking about, what are future tax rates going to look like? And this one is going to come with a little asterisk, because nobody can predict what tax rates are going to look like 10 years from now, let alone 40 years from now. But you have to kind of think where tax rates are going, because the reality is that the tax rates we are experiencing today, that while they are high, right? I think everybody who has an income feels that taxes are high. It's not high relative to the history of what we have seen in America. Like, we've seen times in America where tax rates have passed 90% on your income. And so while, yeah, paying 20, 30, 40% of your income is high, we've seen it go even higher. Now, to understand this, you got to think, why does the government charge taxes? They charge taxes to pay their bills. And what we're seeing is the United States government has been racking up a multi-trillion-dollar national debt. I mean, we're getting close to $35 trillion now, which means our national debt is continuing to grow. At the same time, it's not like this is slowing down anytime soon. The national deficit, which is how much money the government spends every year outside of the dollars that they earn. Remember, because the United States government generates tax dollars, every dollar they spend outside of what they generated from tax dollars is called their national deficit. This national deficit is not really slowing down. We still have an extremely large national deficit, between $1 to $2 trillion every year. It's been above $1 trillion since the pandemic, and it doesn't look like it's going to be under $1 trillion anytime soon. In fact, next year is going to be even more than this year, according to the data. So if we have this situation where the government continues spending, our national debt continues rising, you'd have to think that in the future, there is a high likelihood that tax rates could go up. Not to mention the fact that President Biden has also put out a proposal explaining that he wants to raise taxes. So this is where now there's a high likelihood that tax rates could be higher in the future. Now, it's impossible to predict what they're going to be when it comes time for you to pull your money out. Like, if you're pulling out at 67, we don't know what tax rates are going to be when you were 67 years old. We kind of have to just kind of play with the numbers that we have. And so if there is a higher chance that tax rates could be higher in the future, this is something you really want to be thinking about, because if you are taking a traditional IRA or a traditional 401k, that means you're going to pay taxes when you pull the money out. And if you're having some sort of income in the future, that means that the tax rate could be higher than what it is today. How much higher? I don't know. And don't forget, when you pull the money out, that counts towards your income as well. So these are things you want to be thinking about, which is how much money you're going to be making and what are the future tax rates going to look like. And number 3, which is what is going to give you the most growth. Now, let me explain that by wiping this off. To keep things simple, just work with me on these numbers and assume that this is actually possible. Let's assume that you can invest $100,000 into your 401k or IRA today, and we're going to compare that with a traditional or a Roth, and we're not going to assume that you put any more money into these retirement accounts. So if you take this $100,000 and you're going to put it into your traditional account, what that means is this is money you're going to put in tax-free. That means all $100,000 get to go into this traditional IRA 401k. And let's assume that you're going to keep it in here for 30 years. And for each year, you get an average 10% growth, which means that after 30 years, you didn't put in any more money. This is going to grow to 1.7 million. And now you got to pay taxes. How much taxes? Well, again, this is a question mark based off of what we just discussed, which is what is your income going to look like in the future and what are tax rates going to look like in the future. So what you're actually left with is 1.7 million minus taxes. So you have a question mark as to what you're left with. Now, if we take the same situation, but instead of a traditional, we're going to use a Roth. What happens now, you take the same $100,000 that you're going to put in a Roth, but before it goes into the Roth, what happens? You got to pay your taxes. So let's assume now that you're paying 30% in taxes, which means $70,000 actually makes it into your Roth account because you got to pay taxes first. Now what happens is your money stays here and gets to be invested tax-free. So let's assume the same thing. 30 years in your Roth 401k IRA growing at 10% a year. Now when it comes time for you to retire, you have $1.2 million here. Obviously you have less money here than here. The reason why is because you have less money that goes in. The reason why you have less money that goes in is because you already paid taxes on the money that you earned. Here you have not paid taxes on the money that you've earned. So now how much money do you get to pull out from your Roth 401k or IRA? You get to pull out $1.2 million because you've already paid taxes. Doesn't matter if you're making $10 million a year. When it comes time for you to retire, you've already paid taxes on this income. It doesn't matter if tax rates are 90%. You've already paid taxes on this income. So this $1.2 million is yours. This is what you get to keep. Here, you got $1.7 million and you don't know how much you're going to get to keep. Maybe you get to keep 1.5 million. Maybe you get to keep 0.9 million. $900,000. It depends on what the taxes are and what your tax bracket is going to look like. And that's where you have to go back to what I was just talking about and dive deep into those two questions. Do you plan on increasing your income as you get older? Or do you plan on decreasing your income? And what do you think is going to happen to tax rates? Now, there's one more thing that I want to mention, which I wouldn't feel right making this video without mentioning it, which is you don't have to just have a retirement account to invest your money. Most Americans, unfortunately, don't have any sort of investments. Then out of the people that do have an investment, most of those people only have a retirement account. They have a 401k or an IRA. Most Americans who are investing their money don't have any sort of self-investments. They don't have any stocks that they're investing in themselves. They don't have any real estate that they're investing in themselves. And this is where what I want you to do is think a little bit bigger and don't just rely on these retirement accounts to fund your retirement. The reason why is because back a few decades ago, retirement was called a three-legged stool. You'd have your Social Security, you'd have your pension, and then you'd have your own savings. The problem with that today is pensions are a thing in the past, Social Security is being depleted, and most people have no savings. So now, if we fast forward to what's going on today, if you're under the age of 45, your Social Security check is probably not going to be that much. Okay, I hate to be the person that breaks the bad news to you, but your Social Security check is not going to fund any sort of glorious retirement for you. You're not going to get a pension, which leaves primarily your own investments and your own savings. Now, your 401k, your IRA, this can be a great tool to start with, but this should not be your only investments. I want you to also think about creating your own investments and continue investing to continue padding your wealth outside of just these accounts right here. Now, I know that can be daunting. It can be scary. Oh my God, what brokerage do I use? How do I get started? Where do I invest my money? Where do I put my money? What if the markets go down? I get it. But you don't got to go 0 to 100 today. Take one baby small step at a time. You can look at some of the different brokerages out there. You can look at some of the different ways to invest your money. You can look at investing your money in index funds. You can look at investing your money in ETFs. You can look at investing your money in mutual funds. You can look at investing your money into individual companies. You can look at investing in real estate. There's a lot of things to do. YouTube is a great place to start because it's not going to cost you any money. Then you can read some books and then you can keep dabbling in a little bit. Start with $100, start with $500, start with something that you're comfortable losing. That way you can just start getting your feet wet and then you start putting a little bit more money in. Then you start putting a little bit more money in, because the key is you got to keep investing your money if you want to build wealth. The reality is that's what wealthy people are doing. They're working to grow their assets. The majority of people are working to grow their liabilities. The majority of people are working to grow which cars in their driveway and which house that they're living in. But if you want to build wealth, you got to flip that around and you got to put more emphasis, more time, more energy, and more money into your investments. Now, we have a ton of resources on my channel. And for those of you that are looking for an easy way to stay on top of what's happening in the financial news, you can check out Market Briefs. It's a free newsletter that my team is creating at Briefs Media that breaks down everything you need to know in 5 minutes or less. And I got the link for you down in the description below. Work has a lot of different definitions, but you have to start thinking about what is this mental retirement that I want to have, because if you don't start thinking about this sooner, you're going to get closer and closer to retirement and have no idea what you're going to want to do. If you have parents who don't have hobbies, you know exactly what I mean, because all they know how to do is work and sit at home and watch TV. Well, when you get rid of the work, what does that mean? All you have is sitting at home and watching TV